I'm going to show you how to master the stop loss strategy. I'm going to show you 4 different ways that you're going to be able to execute on a stop loss. First of all, let's go over what is a stop loss. The stop loss is a margin of safety that you're really putting in. So come over here to my screen. I'm just going to draw it out for you. Let's just say that we have something that is $100 per share. And I'm going to use whole numbers here. And you look at this and you say, we'll say that's 100, this is 95, this is 90, and this is 105. So obviously, if you 105. So if you buy it here and the stock price goes up, you make a percentage, right? Now, what if the stock price goes down? What if the stock price goes down and you are not sitting at your computer? Or if you are sitting at your computer, you're willing to say, how much am I actually willing to lose? That's where you can trigger a stop loss. So you're sitting in there saying, okay, if I buy this stock to go long at $100 per share and it comes down to 95, that means I'm down 5%. Is that where I call it quits? And when it comes down 5%, I'm exiting this no matter what. Now, a way that you can do that is just to be at your computer, consistently check on your brokerage account, and then when it falls down 5%, you just exit the stock. Or you could put in there some type of stop where it exits it for you. But the idea is you're putting this in mentally in your head. Or maybe you're the person that says, hey, I need a little bit more risk. I think 10% is my stop loss. So if this thing comes down to $90, you exit it. The idea behind a stop loss, to me, is very, very important, especially when you're day trading. Why day trading? So if you come over here to a 15-minute chart, this is actually a perfect example. I was going to go search for some examples, but this one's pretty good. You have a stock that came up in the morning. Here was the opening of the day. You came up, and you have profits in your pocket, right? Let's say that you're up here. I'm just going to make up a number. Let's say you're up 3%. I haven't even looked at the price yet. And all of a sudden, the stock price starts coming down. At what point are you going to exit? You could have what's called a trailing stop in there. But for number one, for this first one that I want to talk about, it's the mental. You need to be able to sit there and say, and to me, this is the one that you should not use. Let me make that very clear. I do not think that mental stop losses are a good idea. Why? Because if you're up 3% and this thing pulls back and now you're down, or you've given back 1.5%, well, it's much harder for you with human emotion to say, you know what, I'm gonna stay with this thing. I am gonna just let it keep going. It's gonna turn around. It's gonna turn around. Well, that's not how the market works. You need to make sure that you're using different support levels that are built in there, etc. So I do not like the mental one of just saying, I'm gonna go in my brokerage account and execute this. I like putting something in where it's concrete, where the computer just sells it for you, and you are done. So mental stop loss is something that a lot of people use when they get started, or when they're kind of in that wishy-washy stage. They get started, they're getting comfortable with trading, they're about to become a pretty good trader, and they're in that wishy-washy stage, and they get hammered one day. The stock price just pulls back on them, they didn't execute their mental stop loss, and they get drilled. I'm going to tell you a story real quick. There was a day back, I think this was 2014-15, I lost $27,000 in a matter of 2 minutes. It was insane. The stock price just plummeted on me. Why? Because I was using a mental stop loss. After that day, when I was day trading, I never used a mental stop loss again. I always put in a stop limit order, or a stop order that would just sell the stock for me at a designated price when it pulled back X percentage. You do not want to have that mental stop loss, because I was coming down and I was saying, this is going to turn around, this is going to turn around, this is going to turn around. It never turned around. I ended up taking a massive loss on that day, but the lesson was learned. Do not use mental stop losses again. That is a way that you can do it, but I do not recommend it. Now, the second way. I think that this is one of the better ways to do it. And frankly, this is how I do it. So if you're looking at something, and let's go back to that example. Let me draw this example again. You have $100 a share, you have 105, you have 95, and you have 90. So when you go and you buy your stock at $100 and it starts to go up, what do? I always, if I go in and I execute an order, I put in a market order, I put in a limit order, whatever it is, I'm going to put in a market order for this, and I'm going to put in a trailing stop of X percentage. Now, for me, I typically do about 4%. That's kind of my average. Why do I say average? Because stocks that are a little bit more volatile, maybe I'll kick it to 6%. because I'm willing to take a little bit more loss there because I know when I go back to that stock, I'm going to have more opportunity to make gains on it, right? Now, if I'm using something that's a little bit slower, maybe I'll put in like a 2% loss because it takes a while for the stock to go down 2%, but it also takes more time for it to go up 2%. So I kind of gauge it that way depending on the beta and the volatility. But I always put in a trailing stop based on a percentage. So for me, my average is probably about 4%. That's what I like to do. The percent loss is important. So if this goes from 100 and it drops down to 96, automatically the computer exits the stock for me. Now, what if it was a trailing stop? If it was a trailing stop and this went from 100 to 101, now it's 4% from 101, from the peak price. So now it's going to be higher than 96. I'm just going to say 97 just for pure numbers. Then we're going to be exiting the stock at $97 per share, even though it's not exactly that because it's some cents in there. But that you get the general idea of what the trailing stop is and what that percentage means. And that is my favorite way out of these four to go about it. Now the next way, I call this personal. Why do I call it personal? Because it's kind of a hybrid between the percentage and the mental. And you may say, well, the percentage is kind of the same. No, this one's a little bit more. So when we're looking at the personal, you need to go in there and say, okay, I'm more of a high risk type of person. And I'm willing to lose, I'm just going to make up a number, 10%. I'm going to use an extreme number. I don't think you should use 10%, but I'm going to use an extreme number for the example. Or you're a very risk averse person. You're 3% all day. Well, you can come in, and this is why it's called personal. You need to determine the type of emotional person that you are. You cannot be a risk-averse person and think that 10% is going to work for you. It's absolutely not. You cannot be a risk taker and think that 3% is going to work for you because you're going to get stopped out at 3%. You're going to be like, well, that was nothing. I could have gone a lot more on that. It depends on the style of trading that you're going to use. So you have to figure out that mental side. What am I going to let that thing pull back? What am I going to let that emotional roller coaster be like when it pulls back? And then you have to couple it with saying, all right, I need to determine my percentage, and then I'm going to stick to that percentage. So you see, it's kind of a hybrid of the two. That is a very unique way of going about it. And this, for the risk taker, is a pretty good way of going about it because I don't want you risk takers to go out there and just be completely mental. You have to have something in place. But even if you want to put in a 10%, put in a 10%. If you want to put in a 7%, put in a 7%. Risk-taking people, you're going to have to make this exciting and to be profitable in the long term, because when these things start running, you're going to want to stay. You're going to want to continue to stay. You want to continue to stay. If you're a risk-averse person, when a stock price goes up 3%, you're going to be instantly thinking, I need to exit this thing. I need to put profits in. If this thing goes up 7% for a risk taker, they're going to go, how do I get 14%? How do I get 21%? And you're going to stay in it for a little bit longer. So you need to have that personal look inside of yourself and say, what's my risk? What kind of person am I? Then land on a number. So guys, this is a very interesting conversation that we continuously have in the Patreon community as stop losses. You can see from the three that I've given you so far, you can see that it is something that you need to converse about. You need to talk to yourself about. You need to talk to other people about what works for them, what doesn't work for them. Trust me, there's a lot of people in the community that have done things that don't work for them, and that's how they figured it out. Just like I did. I tried the mental stop. It doesn't work for me, so I don't do it. That is the beauty of the community. You can chat with people about it. We have videos on this in the community. We do weekly live streams multiple times per week where we talk about stop losses often. This is one of the most common questions that I get in the community. So join the Patreon. The link is in the description below. You are going to enjoy it. You're going to learn something. And this is a skill that you're going to be able to use for the rest of your life. Now, let's go and look at another way that we can look at stop losses. And I'm going to pull up a longer term chart for this. And the reason I'm pulling this up is because it deals with pattern recognition. Now, this is an easy one. I'm actually going to pull up the swing trading chart. I'm going to pull it up real quick. So if you're looking at this, you're looking at Apple and you're saying, okay, I am going to put my stop at the 25-day moving average. That's that purple line, $229.98. Very simple. Okay? That's where you can put your stop. You can use charts to your advantage. You can use moving averages. If you want to be a little bit more aggressive, let's say that the stock price comes down and it goes through the 25. Put your stop at the 50, 227.09. That's a way that you can use stops. Just say, I'm going to go with a hard number. It's a moving average if your stock is buying moving averages, and that's the way we're going to look at it. Now, if you don't want to look at the moving averages, you look at patterns. And now we look at this and say, okay, I'm going to draw in some resistance support levels. So if you've seen me make videos for quite some time on this channel, you always see me drawing these horizontal lines. That's what I'm going to do right now. So I'm going to draw a couple of lines in here and just go straight across and see where we have these support levels. Now, if you look at this line I drew, check it out. Close of this day right there. And what did it do? It was the close of that day. It was the close of that day. We were kind of in the middle of this day. We hit the trough of that day of the wick, the close of this day, the close of this. You see how I drew that line in there? So that is probably a pretty good spot where if this thing falls, it's going to maybe stick here. It very well could bounce back up, but this is kind of going to be my stop point. You could even go a little bit below it if you wanted to. You could say, you know what? I'm going to go a little bit below that line. So the line was here. Let me change colors. I'm going to draw a new line kind of here. Why to draw that line? Because there's a chance that when the stock price comes down, it hits the yellow line I drew and bounces back. If it goes through the yellow line, it hits the pink one, it might continue to go down. So that's how you can use patterns. Now, let's look at this one more time. This one takes a little bit more time. It takes a little bit more experience, but once you get it, you're going to get it. So let's go to one more line here. Let's draw it a little bit lower. Maybe this is your stop. You can go kind of below into this support level. You see there's a lot of consolidation in here, a lot of consolidation in here, but it's a little bit more risky than when we were up here. So you're going to let it run a little bit more and then maybe bounce off. Maybe it doesn't bounce off. Maybe it goes below. But these are 4 different ways that you can use stop losses to your advantage and that fits your style of trading. Now, I made an ultimate guide for beginning traders. It's a 40+ minute long video. It has bookmarks in it. It is every single thing that you need to know about trading. Go check it out right here. Have a great day.